Hello and welcome to our last unit. And this unit is on standard costing and variance analysis. Okay, so when we go through standard costing, our interest is just to check what we had planned against what we actually achieved. So what happens is, as a business, we are going to come up with our plans, which we can call budgets. But then the difference between standard costing and budgeting is simply that standard costing, we are looking at a unit cost. So we normally consider just a unit cost of producing a product. Then when we take the unit cost of producing a product times the quantities that we want to produce, we then end up with a budget. So there is a close relationship between standard costing and budgeting. Then, of course, we are interested in now matching whatever we planned to pay per unit. Is it what we actually paid when the final actual production takes place? If not, then we now need to look at what is the difference, and that difference is what we call a variance. A variance can be favorable or it can be unfavorable, and then we want now to identify what has caused that variance. If it's favorable, what is it that we did right, which we need to continue doing? If it's unfavorable, what is it that went wrong that we need to rectify? So that's how this whole thing about standard costing goes. Okay, so we are saying standards are just benchmarks for measuring performance. And when we are doing management accounting, there are two standards that we commonly use, which is the price standard and the quantity standard. So you can see now, here we can talk about all the inputs of production. For us to come up with a unit cost, we will have the price per unit of that input times the quantity of units that are used. So when we multiply these two things, the price standard and the quantity standard, what we then have is a standard unit cost. Okay, for example, let's say quantity, we want to produce a product that uses 2 kgs of materials. Then the price of materials is say $1 per kg. So our standard unit cost of the output is then made up of what we pay per kg of materials times the quantity of materials that we need to produce 1 unit. So in this case, it will be $2. So that's basically how standards work. We will have a price standard and we have a quantity standard. Okay, so where do we get the information for setting standards? The per unit cost, we look at the final delivered materials, net of discounts. The quantity standards in terms of materials, we look at the bill of quantities or the bill of materials. We just look at our past performance, how much units of material do we need per each unit that has to be produced. Then we start from there. Then labor standards, where do we get the rate per hour? Where do we get the standard hours that are used? Of course, we use a rate that reflects the mix of wages that are earned, and we use time and motion studies for each labor operation to get the standard hours. Okay, so manufacturing overhead standards, they are normally dependent on labor. So again, we use the rate is the variable portion of the predetermined overhead rate. Then the standard quantity is the activity or the allocation base for predetermined overheads. Basically, we talked about a product being made up of three elements: direct materials, direct labor, and manufacturing overheads. And manufacturing overheads can be divided into variable manufacturing overheads and fixed manufacturing overheads. Then we said if they are variable, then they are easy for us. If they are fixed, then we calculate the predetermined overhead rate for fixed overheads, which we then use to allocate to the products. Okay, so that's how our standards are set. Then we can now come to a standard cost card for 1 unit, and the standard cost card would then look like what we have there. So you can see that we said we normally keep two standards, which is standard for quantities and standard for price. Then when we multiply the two, A times B, we then come to the cost per unit. Okay, performance levels, we are referring to the approaches that businesses use in approaching standards. Okay, they can use ideal standards. When we say ideal, we are referring to the outcome that is mostly that we can say this is an outcome that we want to have, but it's normally not achievable. Okay, so something that is ideal is something that is nice to have, but which is not achievable, or which is difficult to achieve. Okay, then we can proceed to look at attainable standards, and these are standards that allows for machine breakdown. They allow for some downtime, some breaks in production. So these are good standards because they motivate employees. Ideal standards do not motivate employees normally because they don't allow even for normal wastage. So I mean, when we use these to measure performance, the variances are always going to be adverse. And if we use adverse variances or unfavorable variances to punish the employees, then if we use ideal standards, employees are always under punishment. That doesn't motivate. Attainable standards, they do motivate because they allow for anything that is normal that can affect production. Then we have basic standards. These are standards that are kept unchanged for a period of time. We use them as a basis to update our standards as time periods passes. Okay, so which of the following statement is not true? Okay, the statement that is not true, applying the standards, we can see that it's first, let's say variances from ideal standards are useful for pinpointing areas where close examination might result in a large cost savings. Then basic standards may provide an incentive to greater efficiency even though they cannot be achieved. Ideal standards cannot be achieved, so they will always be adverse variances. If the standards are used for budgeting, and allowance will have to be included for these inefficiencies. Then current standards or attainable standards are a better basis for budgeting because they present the level of productivity which management will wish to plan. So which one is not true here? It's B, because if we look at B, the description that has been given is for an ideal standard. It's not for a basic standard. So the statement which is not true is B. Okay, then you need to research on these questions so that you can understand how standard costing is being affected by modern manufacturing technologies. Okay, so using standards in flexible budgets. Okay, a flexible budget is simply a budget that has been revised to take into account the actual activity that took place. Okay, so remember, when we budget, we may budget, let's say, to produce 100 units, and then we say that the cost to produce 1 unit is perhaps $10. So that budget becomes $1,000. But when we then produce 80 units, we cannot now compare the $1,000 for 100 units with the cost that has been incurred for 80 units, because we are not comparing like with like. So when we are flexing, we then revise our budget to say, if we were preparing this budget for 80 units, which is the actual units achieved, if we were to prepare a budget for that, how should the budget look like? So we can now say our plan was to spend $10 per unit, and the actual units that were produced are 80. So if we are to make a budget for 80 units, then it should be 800. Then we are now able to compare the 800 that should be against the actual that has been incurred. So that's the procedure that will follow under variance analysis. So you need to be sure that you are understanding the flexing part of it to reflect what actually happened. Please, variance analysis is not memorizing the formula. You need to understand the formula, you need to understand the mechanics and what gets into that formula. Otherwise, if you just memorize it, you will write for me the formula in the exam or in an assessment, but you won't be able to process the information in the question to fit into the formula, which means you don't understand. And that's the reason why under standard costing, we don't even give marks for the formula, because we want you to use the formula, and when you use the formula, then you have shown that you understand. Okay, so what we investigate is the spending variance. What we investigate is the spending variance. Otherwise, the quantity, the variance that is caused by different operations, which is like in my example, the variance that we will have a variance against what we budgeted with what we have flexed. Like I said, we budget to produce 100 units, and our plan is to spend $10 per unit. So that translates to 1,000. But then when we actually did production, then 80 units were produced, and that, according to our budgeting structure, the budget for 80 units should then be 800. So we can see there is a difference between the 1,000 we budgeted for and the 800 coming from the flexed budget, from the revised budget, the 200. The 200, we already know what caused it. It's just because there was a difference in the activity level. So we don't need to investigate that. We then investigate the spending variance, whereby the actual that has been spent for 80 units is different from the budget that we prepared for 80 units. So that way, we are interested in that variance because the units are the same. So what happened there? Is it because we paid a different price, or is it because we used a different quantity? So we split the variance into the quantity side as well as the price side. So the price variance is the difference between the actual price we paid and the standard price or the budgeted price we are planned to pay. Quantity variance is the difference between the quantity that we have used, the actual quantity we have used, against the actual quantity that we should have used. Why do we do this split? It's because these variances normally take place in different divisions. The price variance is normally the responsibility of the purchasing manager, whilst the quantity variance is normally the responsibility of the production manager. So we need this separation so that we know which side did the variance occur and which corrective measurements can we take. And of course, there is always a fight between procurement and production, where procurement will say, okay, my price variance is unfavorable. The reason is because your production did not plan your things. So I ended up rushing into buying materials because you guys would have stopped the production. So I didn't have enough time to check for good prices. That's why my price variance is not looking good. Then the production manager may also say, no, my quantity variance is not looking good because you procurement bought cheaper materials, and those materials are not yielding good output. So I have to use a lot of materials to produce the quantities that are needed. Therefore, my quantity variance is unfavorable. So those are some of the arguments that happens in real life. Okay, so the general model for variances, we will do material price variance, we will do labor rate variance, and variable overhead rate variance. Of course, we'll also do fixed overhead variances, but we just do the basics because you still do variance analysis in your third year. Then we also do sales variances, but still split into this price variance as well as the quantity variance. Okay, so the price variance, we take the actual quantity of input at the actual price. Then we also get the actual quantity of input at standard price. So when we now take actual quantity at the budgeted price, what we are doing there is we are flexing. So when we now have the actual quantity of input at standard price, that's the flexed budget total. We deduct the actual, then we have the price variance. So normally, in this case, we are saying 2 minus 1. Sometimes it can be 1 minus 2. It doesn't really matter. Our interest here is we are comparing the actual price that we paid against the standard price. So if we actually paid more than what we had budgeted, then that means that variance is unfavorable. So it's not necessarily the mathematical sign that we get, it's more on the understanding of which one is higher than the other and what's the implication of it being higher. If the actual price is higher than the standard price, that's an unfavorable situation because we are looking at maybe you thought you owe somebody $10, then you find that you actually owe the person $20. The actual that you now have to pay is $20. Your plan was you pay $10. Obviously, that's going to be unfavorable to you. So basically, that's it. Of course, if we want to follow the mathematical sign, we can say 2 minus 1. Then we go to the quantity variance. So the quantity variance, we look at the standard quantity of input at standard price. Then we look at the standard quantity allowed for actual output at standard price. So again here, we are flexing. Standard quantity allowed for actual output becomes again another flexing, because what we are saying is we look at what is the quantity of output that has been produced, and then we say, if we were to budget for this actual output, how much of our input should we have budgeted for? Is it labor? Is it materials? How much should we have budgeted for? So that gives us a flexed budget amount. So when we are doing standard costing, of course, we say standard quantity minus actual quantity at the standard price. When we say standard quantity, that standard quantity should then be a flexed budget quantity and not just the quantity that we get from a question. Most students memorize the variances, and then they now don't understand that when we say standard quantity, yes, it's the budgeted quantity, but this budgeted quantity should be flexed first. It should be revised to take into account the actual output. So if our actual output is 80 units, and then we had budgeted that per unit we spend 2 kgs, the standard quantity should then be the 80 units actually produced times the budget usage that we planned per each unit, which is 2 kgs. Then the standard quantity becomes 160 kgs. That's how it goes. Okay, so then when we then take the price variance and then subtract, when we take the standard quantity allowed for actual output at standard price, then we deduct the actual quantity of input at actual price, the answer we get is what we call a spending variance. So you can actually approach questions by first calculating the total variance, then you split that total variance into price and quantity. So when you now add your price variance and your quantity variance, the answer you get should be the total variance. Of course, this is a model for you to understand exactly what is going in there. However, this can be done by means of formulas. So as we go through, you will just see that it's formulas. Okay, then we can now look at our learning objective number 1. We need to compute the direct materials price and quantity variances. Then we explain their significance. So when we are doing this, we are going to be using the model and also giving you the formula so that you can understand what is going on. Please do not memorize the formula. Understand the mechanics that are in the formula. Okay, so let's look at material variances. We want to do the price variance as well as the quantity variance. We have Glacier Peak Outfitters is the following direct material standard for the fiber fill in its mountain parka. Okay, so according to the standard, we use 0.1 kg of fiber fill to produce 1 parka, and each kg of fiber fill we buy it at $5 per kg. That's our plan. So our plan is what is in red. What is in red is our plan. Okay, so notice that we are buying fiber fill so that we produce parka. So parka is the output, fiber fill is the input. Then last month, 210 kgs of fiber fill were purchased and used to make 2,000 parkas. The material costs a total of 1,029. So what you can see here is Let me see. Okay, so what you can see here is if we go according to our plan, we are saying 0.1 kgs are used, and we pay $5 per kg. So that means if we want to produce one packer, we are then going to multiply this times the price here. Now, when we do that, we can find that the answer is 50 cents per packer. Now, if we are spending, if according to our plan, we should spend 50 cents per packer and we produce 2,000 packers, it means we now have to spend 50 cents, okay, times 2,000, okay, times 2,000 there. That should give us 1,000. But according to our plan, we should then have spent 1,000, but we actually spent 1,029. So there is a difference there of 29. According to our plan, we should spend 0.1 kgs to produce one packer, and we pay $5 per kg of fiber fuel. So then 0.1 times 5 kgs gives us 50 cents per unit of packer. Packer is the final product. So multiply it by 2,000, we should have spent 1,000, but we have spent 1,029. So we want to find out what went wrong. Okay, so we start by the price variance. Okay, we start by the price variance. So we are now saying the actual quantity is 210 kgs times $4.90 per kg. Okay, here $4.90, we have just taken the 1,029 that we bought, that we paid, divided by the units that we bought, which is 210. That gives us that $4.90. Then we then take the actual quantity, which is the actual quantity that we used at the standard price. So the actual quantity is 210 kgs and the standard price is $5. So then that gives us 1,050. So we're saying we should have paid 1,050, but we paid 1,029. So according to the price, we made a saving of $21. Then we go to the quantity. Then we are saying according to our plan, we should use 0.1 kgs. According to our plan, we should use 0.1 kgs per packer. So if we produced 2,000 packers, we should then use 200 kgs. But we actually used 210 kgs. So then we are now saying we were supposed to have used materials that amount to 1,000, but we actually used materials that amounted to $50 according to our budget. According to our budget, okay, the budget is we are to spend $5 per kg, and we should spend 0.1 kgs per unit. So if we produce 2,000 units, we should spend 200, but we ended up spending 210. So then again, there is a discrepancy there according to our plan of 50, which is unfavorable because we thought we would spend 1,050. So we thought we would spend 1,000, but we ended up spending 1,050 according to our plan. That gives us a difference of $50 that is unfavorable. So when we now take the $50 that is unfavorable, add it to the 21 that is favorable, it then gives us the $29 that we talked about in the previous slide, to say we should have paid 1,000, but we ended up paying 1,029. So then what went wrong? We see that no, according to the price of buying from the supplier, we did we did benefit, because we paid $4.90 instead of $5 that we had planned. But in terms of usage, that's where things went wrong, because we should have used 200 kgs, but we ended up using 210. So what is the cost implication of that? It's $50 that is unfavorable. Okay, so these two things can be presented in the form of formulas. So material price variance is actual quantity times actual price minus actual quantity times standard price. So you can see in each of these brackets, we do have the actual quantity. So we can actually shorten the whole thing to say actual quantity in bracket actual price minus standard price. Then that gives us our variance. Okay, so the price variance is normally easy. The quantity variance, we need to remember to flex. So as you can see, in the quantity variance, the SQ is in red to show you that that is a flexible amount. We need to first flex. So we're flexing, we are simply saying, according to our plan, we should use 0.1 kgs per each packer. So if we produce 2,000 packers, we should use 200 kgs. Then we compare it to the actual that we used, and it gives us a $50 that is unfavorable. Then when we add the two variances, we'll come back to the total spending variance of 29 that we talked about. Okay, so as I have said, there will always be arguments. Who has the responsibility for what variance? The price variance is at the purchasing manager. The material variance is normally the production manager. And of course, like I said, they always have some arguments, and us as managers then chip in, as management accountants, sorry, we then chip in and try to help these people so that we don't have interdepartmental conflict. Okay, yeah, you can practice on this question. It has a solution, so you can just look at it and try to answer the question. Okay, so these questions, you can do them. The solution is also given here. Then we can go to the next slide. Compute the direct labor rate and efficiency variances and explain their significance. Okay, when it comes to labor, instead of saying price variance, we then say rate variance. And instead of saying quantity variance or volume variance, we then say efficiency variance, but it's still the same approach. So let's now look again at the production of packer. The standard says we should use 1.2 hours per packer, and we are paying $10 per hour. Okay, so we are now saying last month, the employees actually worked 2,500 hours, and the total labor cost was 26,250, and the employees produced 2,000 packers. So according to our plan, we should use 1.2 hours, and we are paying $10 per hour. So one packer is going to cost us $12. One packer is going to cost us $12, which is 1.2 times 10. So if then we produced 2,000 packers, we should then have paid 24,000. We should have paid 24,000. Okay. Now, we did not pay 24,000. We paid 26,250. So then we have an unfavorable total spending variance of 2,250. Okay, so we have overspent by 2,250. What we want to do is to understand what led to this. Did we use more hours than we planned, or did we end up paying a higher price for wages than we planned? Okay, so let's start by the rate variance. Okay, the rate variance, we take the actual hours times the actual rate. So it's 2,500 hours times $10.50, which is simply taking the 26,250 divided by 2,500. Or in many cases, you don't have to get the per hour rate or per unit rate if you are looking at the actual side, because you just get the total there. So when you are calculating your variance, it's simply like just taking the actual total, then you then calculate the actual hours at the standard rate, because that will be given, the standard rate will be given, the actual hours will be given, or there is a means of getting them. Then we just multiply the two. So the left side, this side, like the 26 is already given in the question, so we don't necessarily have to calculate this per hour. But of course, if we approach it from a formula, the formula will require this per hour, but I'll show you how also the formula would work. So we're saying actual hours times actual rate gives us 26,250. Then actual hours at the standard rate of 10 should give us 25. So then the difference, we paid more than we should have according to our plan by 1,250. Then we go to the quantity variance, which is the efficiency variance. We are saying, according to our plan, we should use 1.2 hours. Now, if we produce 2,000 packers, we should then use 2,400 hours, but we used 2,500. So if we have to compare this difference of 2,500 and 2,400 at our standard rate of $10, it means we are out of pocket with 1,000. So if we then add the two, 1,250 and 1,000 would give us the 250 that we were looking for here. Okay. All right. So applying the formulas, you can see we are saying actual hours times actual quantity. So this bracket here, the figure for this whole bracket is already given in the question as 26,250. So instead of dividing it again, we can just say this bracket, we take the 26,250, we plug it there, then we only calculate this side. Then it's much easier. But follow whatever method that makes your life easier. But remember, when we now go to the quantity variance, which is the efficiency variance in this case, we then have to make sure we flex. So the standard hours are the hours that should have been for the actual output. The hours that should have been for the actual output. So our standard is to use 1.2 hours per each unit. If our actual output is 2,000 packers, we should then have used 2,400 hours. But in this case, we used 2,500. So we are 100 hours more. What is the cost implication of that? Which is another 1,000 unfavorable. So basically, that's how the labor variances are going to work. Okay, again, there will be issues that leads to labor variances. Again, this is the responsibility of the production manager because it's the one who is producing, is the one that manages the employees. Of course, issues to do with training of employees can affect labor productivity, can affect the efficiency of labor. The level of motivation can affect that, the quality of production, the quality of training. All these things can affect the efficiency of labor. Okay, then of course there will be other issues. Again, the procurement is there, the production is there, and of course everybody do not want to be the responsible person for anything that is gone wrong. And of course, us as management accountants then can come in and moderate and help these guys improve. Okay, then you can do a quick check on the slides, because the slides are also posted on Moodle and the solution also follows in the slides, so you will be able to work it out. If there are any questions, you can bring those questions to me. Okay, now let's compute the variable manufacturing overhead rate and efficiency variances and explain their significance. Okay, this is going to be the same with how labor is calculated, because in most cases, the variable manufacturing overheads are normally applied or allocated on the basis of labor hours. So the approach to calculate this variance is exactly the same as calculating for labor. So just go back to the labor variance and you will be able to understand, because it's exactly the same information, only that the rate per hour is now 4 here budgeted, and the other one was 5, but the approach is exactly the same. Okay, so you can peruse through the slides and you'll be able to find solutions. Obviously, this approach is the same as for labor. Okay, so you can also do the quick check and see if you understand. And then material variances. Okay, sometimes the material variances can be on materials that has been purchased. Sometimes it can be on materials that has been used. So we then need to read the question and understand where does the when does the material variance get calculated. Is it on materials purchased or it's on materials that have been used? Okay, then compute the fixed manufacturing overhead, expenditure, and volume variance and explain their significance. Okay, so the fixed production overhead variances, these variances are only there if we are using absorption costing, whereby the fixed production overheads are also absorbed into production. If we are using variable costing or marginal costing, we are then saying the fixed overheads do not form part of the production cost, they form part of period cost. So then we only have these fixed production overhead variances if the business is applying absorption costing. But when we are calculating the variance is here. We are simply trying to identify the factors that have led to over or under absorption of overhead. So the total variance, the spending variance, when we are doing fixed production overheads, is simply the over or under absorbed overheads. So when we split then this variance into volume variance and expenditure variance, what we are simply trying to do is what caused over or under absorption. And what causes that is simply in the formula itself, which says total budgeted overheads divided by total budgeted activity. So there are two things that leads to over or under absorption. Either the activity is different, the actual activity is different from what has been budgeted, or the budgeted cost is different from the actual cost that has been incurred, or both of them have changed. Okay, so factors that could lead to under absorption of overheads, we then call the variance, an adverse variance or an unfavorable variance. Factors that lead to over absorption, as you recall from our topic on overheads, we said under absorption is taken as an expense, so that's why the variance is going to be an unfavorable variance. Then over allocated, we said we take it as an income, so then that's why we also have a variance that comes from it as a favorable variance. Okay, so we have already said there are two reasons why fixed overheads are under or over absorbed, and the reason comes from the formula. Okay, so let's look at an example. A company manufactures a single product. Budget and actual data for the latest period are as follows. Fixed production overheads expenditure according to our budget is 103. Production output, planned production is 10,300. Then actual production overhead expenditure was 108,540. The units produced were 10605. Then calculate the fixed overhead variances. The two variances are the expenditure variance and the volume variance. So the expenditure, we first calculate our POR and we get it as $10 per unit. Okay, POR, budgeted overheads over budgeted activity. So then we are now saying over or under absorbed overheads in this case is 2,490. So we have under absorbed, that's why the variance is unfavorable. Overheads absorbed, remember, it's POR times actual activity. POR times actual activity. So $10 per unit times 10,605 units would give us that 106. Then the expenditure variance is simply taking the budgeted overheads minus the actual overheads that were paid for or that were incurred. Then that gives us 5,540, which is unfavorable. Yes, this is unfavorable because we have incurred more cost than we anticipated. Then the volume variance is simply looking at the budgeted volume is 10,300. The actual volume is 10,605. So that gives us 305. That 305 is favorable, is a good thing, because remember, if you have fixed overheads, the more output you produce, the less cost per unit we get. So in this case, this is a favorable thing because it means our cost per unit, our fixed cost per unit are going to be less because we produced more units. Therefore, the 305 is favorable. We multiply with 10, then we get we get the 3050. So if we then look at the 3050, which is favorable, with the 5540 that is unfavorable, we then add the two, we come to the total variance, which is the under allocated overhead. So when we do the expenditure variance and the volume variance, our interest is simply to look at what has caused under absorption of overheads in this case. So we can see that the first thing that caused under absorption was that the budgeted overheads, the total budgeted, which we used in our POR, was less than what we actually incurred. Then the other thing that happened was the actual volume was also different from what we planned. Therefore, that's why we had under allocation of overheads. Okay, so what is the difference between the expenditure variances for fixed overheads and for variable overhead? The answer is, for variable, we flex. We want to get what it should have been for the budgeted, for the actual output. However, for fixed overheads, we don't flex because fixed overheads are not supposed to vary per unit. Fixed overheads are supposed to be fixed. Therefore, we don't flex when we are dealing with fixed overheads. That's the difference. Okay, then sales variances. Sales variances, again, we look at them from the two model perspective. We have the sales price variance, we have the sales volume variance, and what we are interested in is finding out whether the selling price that we anticipated was the same as the one that we actually sold, and if they are different, what is the implication on our profit. The volume variance, same thing. We look at the volume that we anticipated against the volume that we actually achieved, and what is the profit implication of the change in volume. Okay, so notice that we are going to use the price variance. We use the actual quantity that we sold times the actual price that we charged, and the actual quantity that we sold times the standard price that we charged. So the difference between these two figures are going to be our price variance. So you can see in each of the formulas, in each of the bracket, we have actual quantity. So this is the same as just saying actual quantity times actual price minus standard price, which is the same price variance as we dealt with in cost variances. Now, the next one is the volume variance, and with this variance now, you now need to understand that we are going to use the standard margin, not the standard price this time. We will use the standard margin. The price variance is already taken into account the profit change as a result of a different price. We now need to look at the margin, and the margin can either be contribution if the business is using variable or marginal costing, or it can be gross profit per unit if we are using absorption costing. Okay, so here just notice that the volume variance is the one that is different because we use the standard margin instead of the standard price. And the standard margin is dependent on whether we are using absorption costing or we are using marginal or variable costing. Okay, so there is a question that you can try out. You can try out that question, then I'll give you the solution after you have tried it out. Okay, so finally, what are the advantages of using standard costs? We are saying they enable management to do a management by exception approach by trying to look at areas that require improvement and give them more focus than other areas. Standards can greatly simplify bookkeeping, yes, because we have a basis where we are starting from, so our bookkeeping becomes slightly easier. Standards can provide benchmark for promoting economy and efficiencies. Yes, when we investigate the variances and we see that they are unfavorable or favorable, we are able to promote economy by trying to ensure that the unfavorable variances are turned into favorable and the favorable variances are maintained as favorable. Standards can support responsibility accounting systems. Yes, because we are pinpointing the area of responsibility. Remember, we split the total variance into the price and quantity, and we said the responsibility of the price is on the procurement manager, whilst the production manager is responsible for the quantity. By so doing, we are already applying responsibility accounting because each manager is held responsible for what he or she can control. Okay, then of course there are potential problems with standard costing. Okay, standard cost variance reports are usually prepared on a monthly basis, so they may contain information which is outdated. Okay, then variances, if they are also used to punish employees, we may end up with morale being morale declining or employees getting demotivated, so then they end up doing dysfunctional decisions. Okay, if you punish them for taking too much time in producing a product because their labor variances are unfavorable, employees will do it faster, but they may do it with a lot of mistakes, and then that can be a bigger problem because it compromises quality. So if we use variances to punish employees, we may also get a wrong outcome in the end. Labor variances assume that production process is labor intensive, and also we are assuming that labor is a variable cost. In many cases, applying the modern manufacturing environment, the automated manufacturing environment, we are now using less of employees, and labor is also become a fixed cost. So those are the downside of preparing standard costs. I've also, this is a similar question that I have given you in the homework for you to look at how standard costing affects TQM or affect automated manufacturing environment. Okay, then the problems also continue. Meeting standard may not be sufficient. We may meet standard but not because meeting standard is cost based. It does not bring in the issue of quality. So sometimes we also need to do other things better than other businesses rather than just saving cost. In some cases, a favorable variance can be as bad or worse than unfavorable variance. Yes, it may happen if we produce favorable variances because we are cutting on quality. That favorable variance is also as bad as unfavorable variance because it has other consequences. Then excessive emphasis on cost, as I've said, is going to compromise the quality that is going to be produced, and that can harm customer satisfaction. Okay, so essentially that was our topic, standard costing. Remember not to memorize the formulas. Remember to also flex when you are doing the quantity variances to reflect what the budget should have been for the actual output that was produced. So yeah, we end there with our variance analysis. I will then post questions, and your student tutor will help you to answer those questions if she's available. I'm also available to help you answer those questions should you have any. Thank you.